Hi, this is Randy Finney with Right Side of the Chart, and this is a market update for Friday, December 7th, 2018. Initially, I was planning to hold off probably until this afternoon or to a closing market wrap as I did yesterday. But I wanted to get this out there. And the reason for that is, up until this morning, early on today, not a lot had changed. In the update yesterday, if you recall, if you caught that one, I mentioned that the SPY had rallied right up, both SPY and QQQ had rallied up to resistance. On SPY, we had this big gap right here, a very large gap, which was backfilled. Naturally, the top of a gap is resistance, and we also, as you can see, that's not the only gap there. There's one, two, three gaps, and a lot of reactions there. So that's a well-defined resistance level, and we hit that. SPY tried again today to take it out. We hit that, rallied into the close yesterday, roughly around that level. Tried it again, and now that was met with impulsive selling. So what I'm seeing here, again, the near-term outlook, I can certainly tell you this: it's choppy. I don't need to tell you that. I continue to maintain this market will, if you are not a very active, nimble, adept trader, this market will chew you up and spit you out into pieces if you're trying to game it, actively trading. Right now, bigger picture, I'll get to that in a second, maybe touch on it. Nothing is saying we're back below the 50, 200-day moving average. There's everything by nearly all metrics. The trend is still bearish. So although there's a chance for a bounce, now you can look at we've had pretty much a triple bottom so far in SPY. Now let me say something to that. Triple bottoms and triple tops are potential reversal patterns in technical analysis. However, they come typically you want to use them after a prolonged downtrend. In other words, if we were in a bear market and we saw a triple bottom low or of a correction that lasted for many, many months, if not a year or more, then you might look for that. We're just off the highs, so now anything's possible. To really simplify this, here's the big picture in the stock market, at least the S&P 500, which is the market. We're in this trading range, and we have been here for the last couple months, and you can see we've had almost three equal highs and three equal lows. We're going to go one way or the other, break from this thing. This has just been, every time we get when I talk about the daily charts and I talk about how it's just been a slugfest between bulls and bears, you get these big green candles answered by a big red candle. It's almost a daily occurrence now. But what I noticed today, and you probably noticed this if you were trading, the SPY got smacked down hard. This is the open today, so you can see we popped up a little bit at the open and then a pretty hard impulsive sell-off. We're down 1.4% as I'm doing this. QQQ even harder. See, QQQ, as I mentioned, ran into resistance yesterday. It was a back test of a trend line. I'll get to that in a second. Tried to pop above there today, failed again. We stopped there yesterday, so we didn't exactly fail. Popped above there, failed, came back, and again, I mentioned it yesterday, I believe, right at the downtrend when we hit that on the 60-minute chart, and there it is. So there's a failed attempt, another back test of that level, and then boom, very impulsive selling. This drop from high to low today, and again, this is the nature of the beast lately. That's why it can really hurt you because the market's moving fast. If you're using too large a position size or you're not using stops, that's a drop of what is it over there? 2.4%. 1 minute chart has some bullish divergence here, but that's a 1 minute chart. Here's a 60-minute chart of QQQ. Something's going on with TC2000. This charting program I don't know if it's only issues on my end. A lot of the trend lines I've been drawing recently, if anyone else is experiencing this, let me know. Some of the charts I go to, the horizontal lines are moved up even if the stock hasn't split, if the stock or ETF's in the same price. Yesterday I did a video, I had an uptrend line which I just had to replicate. These levels are changing on me recently. Again, I don't know. I know they've had some problems with their Forex quotes recently, but not very happy. But I wanted to just make mention there that there's that back test in QQQ yesterday. And again today, and so far a violent rejection off there. So while the range on QQQ isn't as well defined, on SPY I just showed it to you a minute ago, is a boxed in sideways trading range with roughly three equal highs, three equal lows. QQQ has been more of a downtrend type range, similar box but angled down, and so of course, you want to watch. I put a little heavier emphasis right now on SPY because it is a broad market, and I'm doing this video because it appears to me, and I've I've urged caution to those that aren't active traders, and also talked about how the risk reward to the downside isn't very attractive as you get down to this level, this oversold, so close to the sports. But it seems to me, in today's SmackDown added to that a little bit more. The market had a chance to build on yesterday's gains. It did, and it didn't do it. It failed, and it failed very impulsively. Again, sort of the nature of the beast. You can go back and forth. You'll become schizophrenic on this market, bullish one day, bearish the next, and it's hard to. But it seems to me that this market just doesn't want to go up. There's a lot of sellers lurking in the shadows until we get a flush out move. That's what I had made a post in the trading room shortly before doing this video. So that's what I think is going to happen. And if you're an active trader, you want to put a short on here. And you realize, especially if you're trading index ETFs, because you are prone to a gap up that can blow right past your stop. Futures, you have a little more control as they trade around the clock. But today's Friday. You take a short position or a long position for that matter, you have 2 days of overnight risk. And even in the futures, they will stop trading today, later today, and they will not open again until Sunday night. So caveat emptor, buyer beware. It's up to you if you are short, seller beware, whatever you do. Here's the EMAs. I don't have them tuned up here, but I'm sure a lot of people are talking about this now. Maybe, in my opinion, I think I said this yesterday, too many people really watching this, just like too many people talking about the yield curve inversion. What happens when everyone's watching the same thing. So either way, it looks like these lines are going to kiss. The MACDs, the PPO is pointed lower. This is a SPY daily chart, by the way. The 50 is about to cross down below the 200. At this point, we might as well just get it out of the way. It's going to cross. I think what'll happen, it'll cross. The media will make a big stink about it. It'll be all over the blogosphere. Even the algos somebody asked me if the algorithmic programs will start firing off sell signals just like they did. At least that's what most people are trying to attribute the big drop that we had the other day to the yield curve inversion, which, by the way, was the short term. It was the 2 and 5 years. The 2-year inverted down under the 5-year yield. Typically, I look for the 2 to go under the 10-year, but that hasn't happened yet. And again, a lot of people watching it. Maybe that was the cause for the big swoon down the other day. And maybe we get one again. I find it hard to believe that these super intelligent people that write these programs and those that allow them to be run will fire off on such a simple thing. Okay, if this line's here now, we're bullish, everything's okay. But the second it crosses, everything's changed. Who knows? Maybe we'll see it. But I know I might be rambling here, but I think that's probably going to, at least a good part of it will happen. Whether or not the algos step in and sell if we get that cross, I think the traders are going to do it. I think stops will be hit. There'll be a little panic. And so to try to sum up my thoughts for you right now, I think the odds are looking pretty good at this point, better than they were recently, that we do get that final flush out move. So many people clamoring for a test of those early 2018 lows right here. And as I told you before, they're not going to make it easy. There's an infinite number of possibilities, but what I was going to get at is, a perfect test of those lows. It's possible, but it would be almost too easy. So you're either going to fall just shy, or you're going to shoot down below them. And at this point, I'd have to say I might lean towards a flush out below those. And so this is why I'm doing this video. If you are, regressive and you're already short, or you want to put on some shorts here, that may be, as I've been saying, another 5% plus downside. It would be about 5% on SPY down to that February low. And one thing I need to reiterate, I've said this in the past recently. I can tell you from experience, and I love shorting just as much as going long, and I do a lot of it. When shorting, the profit potential, I love shorting because there's no way to make such quick profits in such short order. Generally speaking, I should say. There's some longs that explode to the upside, but for the most part, stocks tend to fall much faster than they rise. You can simply go back any chart, long period of time, look at corrections. There's in just a few days there, months of gains were wiped out. Same story here, months of gains wiped out in just a couple weeks. That's the nature of the beast. That's why I love shorting. Now, with that being said, and I've said this before, When you short, you cannot stay late to the party. You do not want to be the last one to leave the party, because what happens is once a correction on the short side is over, the bounce is usually very fast. When whatever that reason, when support is hit, when that's the end of the correction, typically, traditionally, I've done a very good job of identifying that and getting out and have my price targets right there and then reversing and catching that. But I want to make that clear. If you are trying to ride this thing down, I know there are quite a few in the trading room, and on the site that shorted anywhere in here, and they're just holding off to see evidence of a bottom. And I think that's a good thing. That's what a really a less active swing trader should do. Nothing has changed in the charts significantly to say that this correction is over yet. In fact, we just bounced back and had a typical kickback rally. So what I'm getting at is you want to have that there, but be careful if you get that selling climax that some people are looking for. The reversal may come very fast. And one way to protect yourself, especially if you work a full-time job and you're not in front of the computer all day, you can set a trailing stop. Now, unfortunately, in this market with these 3% plus daily gyrations, you're going to have a pretty loose trailing stop. Let's just say 5%. 5% would probably keep you in the trade most of the time. It wouldn't have all along this whole thing, but at least on this leg down, if from here we're going down. Let's just go under that assumption. Right now, these MAs are poised to cross. Let's just assume we're not getting another kickback rally. It's certainly a possibility, but that's something to look at. PPO is pointing lower right now, so the charts are, at this point in time, looking pretty weak. There's that triple bottom in SPY. Whether that holds or not, only time will tell. And you know what I said, that corrections don't end in triple bottoms. This was roughly a triple bottom, although we came up, we were dancing along the uptrend line right here, and I'm referring to back in earlier in the year. 1, 2, 3. Although these were more so trend line tags, and this I don't consider really a triple bottom. It wasn't, equal lows like these here. Okay, now let's look at the almighty Qs, QQQ. This is just a clean daily chart. I only have one line on there. Just ignore that level right there. Again, something funky going on. If you use TC2000, you have these boards over here, and these are supposed to have, and some of them do have my annotations right now and trend lines, but a lot of stuff has been moved. I have some trend lines, divergence lines, other things missing. I really don't know what's going on. I assume it's an issue with TC2000 right now, so just bear with me on these charts. So here's the 50-day coming down hard. We're about to have a bearish cross, or what we call a death cross, when the slower moving average, or the faster moving average, which is the 50-day moving average, crosses down below the slower moving average, which in this case is a 200. Really, a death cross is referred to any pair crossing over when you get the bearish cross, but the 200 and the 50 are probably probably the two most watched moving averages, especially when used with those death crosses. And in the past, they've done a pretty decent job of signaling, trend changes. So there they are. If I put the crosshairs and you look at the pop-up box to the left, you can see the 50-day right now is at 170.32, whereas the 200-day is at 170.24. So just a hair above. Sometimes they kiss and bounce, but right now, if any more downside today or next week, you're going to have that death cross. And again, that may trigger another wave down. It may trigger whipsaw signal. And guys, I know if I sound, uh, undecisive, throwing out some different scenarios, that's because it is. The risk here, again, shorting, while we've already come down so much, we already put in a divergent low on the daily chart. Again, all my annotations are gone there, but we had the positive divergence, everything I mentioned. Means that this could be just a big fake out move. We get that death cross. Maybe we shoot down one day and then the algos come in and buy this market up real hard, trap a lot of shorts in that move. But if I had to pick one or the two, I'm going to lean towards a flush out move. Again, come in and test these lows, give or take, back from earlier in the year. And in QQQ, that would be a pretty good move down. If we come into the horizontal line is now at the March or the April low, that's 6% downside in QQQ. If we happen to make it all the way down to that February low, you're talking about 8% or so. So that may be worth it to you, again, if you understand the risk of being caught in a sudden reversal. and you know how to manage your stops, then you may want to short that and try for that runner trade down, 5-8%, give or take. We'll let the charts be our guide. If anything pops up that looks like, hey, maybe it's time to cover, I'll let you know. I'm not going to add this as an official trade right now because, again, the risk reward is not that good. And there are a lot of traders on the site that, with different experience levels. I like these clearly objective ones. Last time we had an official short trade was right here on this kickback rally on QQQ. All right, let's just wrap this up with the futures. There's really not much more I want to go over in the charts right now. This is the ES S&P 500 E-mini futures 60-minute chart. You can see we've come back down to that 2651, 25-ish resistance or support level I mentioned the other day. Then we have below that again 2625 if that gets taken out, and then that's it. And although we had multiple tests here before, you can see multiple tests here at that level, 2 tests in a row, almost 3 if you count that one, about 3 or 4 there, only 1 so far. My guess, if we come to it again, we're going to take it out. That's just from experience. I think at the stage we're at with what's happening now, although I mentioned yesterday or the day before, buying, going long, expecting a bounce from this level, anywhere from that 261.51 down to the 26.25.35. Although that I thought was a buying op, I don't think the next one will be. Just again, intuition, experience from where we're at right now. We did put in, by the way, a quick, small little divergent high, at least there on the RSI, maybe on the PPO a little bit. But we need to see that level hold. You don't want to short right at support. When we dropped today, we hit that support level. So far, we bounced. So you're looking to, short this market, or maybe you're looking to go long. Maybe this whole death cross thing scare and the yield curve has just been the one last buying opportunity to get in long here at the bottom of the range before we go up and break to the upside. So if you are of that mindset, then this is where you want to buy. You want to buy here. And you might want to, scale and keep it light. And if you drop here, you buy again. And I would also say this, because I would expect a break of that level the next time we hit it. If I were to be going long, which right now I'm not, that could change, but if I were, I would allow for a little bit of a washout move below. And I know that in percentage terms that gets pretty big. And you might say, well, Randy, that's going to be, 4, 5, 6%, whatever. It might exceed your usual stop. How do you manage that without, by staying in the position without getting stopped out? Reduce your position size. That's what the official trade ideas on the site. I use what I call beta adjusted position size. And so if I have a volatile little gold mining stock or a marijuana stock that, swings up and down double digits a day, how do I stay in that trade knowing that I cannot possibly swing trade that stock with a 5 or 8% stop loss, or I'll be guaranteed to be stopped out within a few days just due to the volatility. So how do I trade it effectively? Is I reduce my position size down to the point where I can allow for whatever need be. Let's say in that marijuana stock example, it might be a 20% stop loss, maybe even greater if I'm shooting for 100% plus return. And again, it's all relative. So if I cut my position size down to a fourth of or less of what I might normally take, yes, I am cutting my profit potential down. But if I'm shooting for 100% return, I'm still making more money total dollar-wise than I would make on a regular trade. And I'm also in same thing with the stop. If I allow a 20% stop on that trade, but I'm only taking a 1/4 or smaller position size, and that's a 5% stop on a normal trade. Same thing happens here with the futures or SPY or whatever. If if you want to try to successfully swing trade this market without getting clipped out on all these ups and downs, you're not going to do it with your full normal position size. The gain potential is above average now, as is your loss potential. So simply take your position size down, and then that'll allow you a larger stop in percentage terms, but yet your total dollar amount lost if you're wrong on the trade would be within your normal parameters. So, all right, that's that. Let's wrap it up here so I can get this out to you guys. And like I said, at this point, I did add back. I mentioned yesterday closing out my NQ long, and I didn't plan to add anything back on today. And I even said that earlier, but then I did. I added before I did this video, took a short on NQ, and I may even end up taking it home. I'll make that decision before the close today. I can tell you I won't be going home super heavy, long or short, anything on the indexes, at least not in my trading account. But let's leave it here, and I will do an update by the close if anything changes. But as of now, that's what I'm leaning towards, guys. I think they're going to need to flush this market out. It just doesn't seem to want to bottom like this. There's just too much. And of course, a lot more goes into that. I've looked at individual sectors, individual stocks. I don't just solely analyze the major indexes and the futures. So it seems to me there's probably more downside before we take out the top of this range or even come back to test it again. All right, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you found it useful.